All right, welcome everybody to another exciting episode about taxes. So today we're going to talk about rental income. So this episode will actually be fairly short because there's not a whole lot to say there. But what I will do is concentrate on the things that are a little bit unique to the rental world. And so we're going to jump right into it. So basically, what I want to expand upon today is just what's deductible and what to think about if you have a rental, whether it be residential or commercial. The rules are the same. So if any of you have listened to the episode we did on what's deductible and what's not for income taxes, it's about almost an hour long episode that we did about a couple of months ago. I suggest you may want to have a listen to that one if you haven't already, because the rules are the same. So what I'm going to concentrate on today is what is a little bit more specific to rental. So just as it is in any business, if you can prove that the expense was incurred and was a necessary evil related to the rental income, it makes the expense tax deductible. So the same two questions as applies as it does for business is that, and I keep saying if you answer yes to one of the following two questions, then the expense is likely deductible. So question number one, is the expense a necessary evil towards earning this income? Or number two, is will the expense possibly increase revenues or profits for the business? So for example, advertising your property, while it's not a necessary evil, but it certainly will possibly contribute to the success of your rental. Um, so the expenses that will generally apply to rental will be things like, and I'm just going to read them off because I don't know this really by heart, but like utilities, property taxes, insurance, depreciation. But depreciation is something you may want to be careful about, and we're going to possibly discuss that a little bit, and repairs. Um, but repairs is where I want to spend a little bit more time because this is where a lot of people get a little bit confused as to what can I claim as it relates to the repairs of a building. So where people often get confused is that they will mix up or get confused between renos and repairs, and there is a difference. And the difference is that a repair will be considered as an expense that you can deduct in the current year, whereas renovations is something you need to capitalize. So I'm going to go over those differences between the two, between a repair and a reno. So first of all, if you are have just bought a house or just converted that house into a rental, then what happens is that any expense that you incur prior to the tenant moving in will be considered a renovation. So all of these expenses that you incur prior to the tenant moving into the location will need to be capitalized and added to the cost of the building. Once the tenant has moved in, most of the repairs you're going to do are likely going to be capitalized, or that is seen as a repair. Now, where it becomes a renovation is when you're not putting things back into its original shape. So, for example, um, you decide to add a window to the dining room, a window that was never there. Well, because the cost of the window will be considered a renovation because you didn't have a window there. On the other hand, if you did have a window and now you just chose put in a new window, that will be a repair because what you're doing is you're putting the window back to its original shape. Now, where it gets a little bit confusing sometimes is when it's new technology. So, the Income Tax Act talks about putting things back to its original shape. But you're going to say, but I've got a 20-year-old furnace in there. Does that mean I need to go shopping for another 20-year-old furnace or of the same caliber? Well, of course, you're not going to find a furnace like they made them 20 years ago. You're going to have to buy new technology. So the furnace that you're likely going to buy is going to be far more efficient and all of that than your old furnace. But that is considered okay. It's still considered uh, a repair because it's new technology for which you had no choice but to go to. And the same thing would apply to, say, windows. So you may have had very thin, inefficient windows, and now you're putting very efficient windows, triple pane, or whatever, that would also be okay and considered as a repair and not as a renovation. So that's okay. Where you may run into problems, like I said, if you're putting a window somewhere where there was no window, you're upgrading the linoleum to a hardwood floor. That would probably be considered as a renovation and not as a repair, because the hardwood floor would be considered as a higher class or a higher quality than the linoleum, and the linoleum is not, it's just a new technology. So that's where you make that distinction. One of the things I usually suggest, if you're not sure, contact us or your experienced accountant, and they could probably guide you as to the difference between a repair and a renovation. Other than that, there's really not a whole lot to say about rental. It is really very simple. What you need to report on your taxes are your revenues minus all of the tax deductible expenses, and and the only thing like I said, I would be careful about would be the depreciation, and not necessarily claim all the depreciation. So, Kayla, did you have any questions? Kayla, maybe she's on mute. Okay, well, while we're trying to get her online, I thought maybe it would be a good idea to expand a little bit more upon the depreciation. I just realized I haven't said enough maybe about that. When the time comes for you to sell your house, one of the things you need to be careful about is the fact that when you sell the house, you will have to pay capital gains on the increase in value of the house. So let's just say you bought the house for 100,000, you sell it for 140,000. You will need to pay taxes on the increase in value of $40,000. If it goes up from 100 to 140, you will pay taxes as a capital gain on the increase in $40,000. But on top of that, you may be stuck with paying something called recapture. And what recapture is when you claim depreciation on your house. So going back to the original example, you bought a house for $100,000. You had it for a number of years, and you claim depreciation every year as an expense to reduce current year's taxes. And let's just say over the years, you've claimed $20,000 of depreciation. So your house will have gone from having a book value of 100,000 down to 80,000. The day you sell the house, if you sell it for more than what you paid for it, so in other words, you sell it for 140, now you're not only having to pay taxes on the $40,000 capital gain, but also on the $20,000 of recapture, being the depreciation you claimed over those years. So the difference between the book value and the adjusted cost base will also become a taxable income upon sale of the property. So there, is Kayla back on, or are we done? If not, that'll pretty much conclude this presentation. Okay, so I think we're done. We can call it a wrap.